Hey everybody, welcome to Make Money Math Time, the place where we do math to make money. So if you like either of those, make sure you subscribe for future episodes. Today we're realizing that putting money in a savings account actually won't help you at all. Only other kinds of investments will. Today's going to be a little bit different. Instead of jumping into the nitty-gritty numbers, we're going to focus on theoretical concepts relating to the stock market. Now I know the stock market can be a daunting thing. It goes up and down, it's very unpredictable. And for someone who's had money in their bank their entire life, putting money in the stock market is a very scary thing. When I talk to my friends who don't have money in the stock market, they usually tell me one of three things. First is they don't have enough money to start. The second is they don't know where to start. And the third is that it's just too dangerous. Well, I'm hoping to show you that all three of those things really don't hold any water. So let's jump into it. So the first reason people tell me that they don't invest in the stock market is because they don't have enough money to invest. And years ago, this used to be true. It used to cost a lot of money to call up a broker and have them make a trade for you. However, more recently with online trading, trades have dropped down to $15 or $10 a trade. And most recently, actually in October of 2019, there's been a couple companies announce that there are no longer any transaction fees associated with trades. So you can buy and sell stock for absolutely $0 on the transaction fee. That's very, very good news for basic traders like you and me. So the idea of not having enough money to start investing in the stock market doesn't really work anymore. So when we look at the second excuse that people have, it's that they don't know where to start. And this is still a very valid excuse. There are thousands of publicly traded companies, countless mutual funds and ETFs, and it's very difficult to know where to start. So for me, I always go back to a story that happened in 2008. Warren Buffett, one of the greatest investing minds of all time, went to a handful of hedge fund managers. These are professionals who run hedge funds and they eat, live, and breathe money. He went to them and he said, I bet that you cannot beat just the average stock market. Do all your day trading, do anything you want, and you can't beat just the average stock market. Well, 10 years later, not a single one of those people were able to beat the stock market. So I know there are things out there called index funds. These are funds that are just designed to mirror the market. So I know if I place my money in those, I'm actually going to be a lot better off than professionals who do this for a living. So we've seen that it's no longer cost prohibitive to enter the stock market. We've also discovered these index funds, which seem to be a relatively good place to start. The last excuse that people have to not enter the stock market is that it's just too risky. But for that, I think we should actually look at the numbers. So I'm including a spreadsheet in the description where you can plug in your own numbers and see what kind of return you think you will get. All the math's done for you, you just got to plug in your own numbers. So that's in the description, so definitely check that out. Okay, so starting off, let's say you have $400 and you put that money under your mattress and 10 years later you pull it out, it's still $400. That's great. It hasn't gone up or down with the stock market. There's no risk in that. Until we realize that inflation is a very real thing. 10 years ago, I was renting a bedroom in a 3-bedroom house for $400. Today, that same bedroom costs $800 a month. So that money that I put under my mattress 10 years ago could pay off a month of rent, but today only can pay half. Now, that may be an extreme example because I live in a quickly growing city. The government tells us that inflation is 1.7% a year. I find that hard to believe, but let's say that's true. Well, over a course of 10 years, it's probably going to fluctuate a little bit. So we're going to go with 2.15. When we plug that in, we realize that after 10 years of inflation, that $400 is now worth today's value of $323.23. So we've lost $80 just by having it under the mattress. So we've seen that putting our money in the mattress, not a great idea. Even though the stock market is risky, putting it under the mattress is a guaranteed loss. So what are our other options? We look to savings accounts, right? Savings accounts, the good ones today, get about 2% back. That is higher than inflation. So it sounds like in 10 years, we'll be able to grow our money some. However, we neglect the factor of capital gains tax, which is something that when your money makes money, the government still wants a cut of that. For the vast majority of people, it's 15%. So when we look into it, the 2% suddenly gets lower because we're having to pay capital gains tax on it. Well, what is 15% off of that 2%? Surprise, it is 1.7%, which is exactly inflation. So what that means is we put the $400 in our savings account, and even though it seems like it's growing, 10 years later, what we pull out has the exact purchasing power as $400 today. So with savings accounts, I do think it is important to note that this number is going to fluctuate as inflation changes. In the 70s and 80s, inflation was really crazy. It got up to 8, 9, 10%. This means that at that time, the savings accounts were actually returning close to 12%. So the savings account were actually doing better than the stock market. So there is a situation when, depending on what inflation is at. Do you want to put your money in bonds, in stocks? That's why when I was a lot younger, my parents discussed bonds versus stocks, whereas today when you look at bonds, the rate is so low that the stock market seems much more appealing. So the mattress is a guaranteed loss. Putting it into a savings account seems like it's going to stay the same value over 10 years. Well, the stock market still seems pretty risky, right? There's been the Great Recession, there was the dot-com boom, there was the Depression way back in the day. So there are so many ups and downs that can you really trust the stock market? So when it comes to stocks, you may have heard about the Dow Jones. There's certain stock indexes that basically try to represent the economy as a whole. There's the Dow Jones, there's the S&P 500, and the NASDAQ are three of the most popular ones. The one I like is the S&P 500. It's a collection of 500 stocks, so it has a much broader base of stocks to represent the economy. So when I look at the S&P 500 historical values, I'm going to look at October 1st from different years. So October 1st, 2019, most recently, the value has been 2,940. We look at 5 years ago, it's just over 1,900. So what that means is over 5 years, it's had an average annual return of 8.7%. That is much higher than our savings account. Okay, so we say, what about 10 years back? Well, October 1st, 2009, we're looking at 1,067. That is an average return of 10.66% every single year for 10 years. And you think, okay, well, that was on the bounce back of the recession, so that data is going to be biased. Sure, okay, that sounds good. Let's go back 20 years. So 20 years will include the Great Recession. 20 years will include the dot-com bust. So when I look at October 1st, 1999, I'm looking at just about 1,300 exactly. And what that means is that's an average annual return of 4.17%. So we've gone through the dot-com bust, we've gone through the Great Recession, we've gone through these terrible economic downturns, and we're still getting 4.17%, which is more than double the best savings account. So we say, okay, maybe 20 years is biased. Let's look at 50 years' time. So we look at October 1st, 1969. We see the S&P is at 95. That is an average annual return of 7.09%. 7.09% over 50 years. That's a ton of money. That is so much higher than the current savings accounts right now. So that number, 7.09 over 50 years, seems very reliable. It seems like it's at least fluctuating somewhere between 4 and 10, which is the highest and lowest, right? So we take that $400, we're not putting it in the mattress, we're not putting it in a savings account, we're putting it in the stock market, and we're going to assume that's 7.09%. If you think that's too high and you want to add in your own numbers, feel free to do that on the spreadsheet, and you can see what the return would be otherwise. So you put in $400, and in 50 years' time, that $400 turns into $12,288. That is massive. That's a massive increase. So that doesn't account for the capital gains tax that we're going to have to pay. That also doesn't account for inflation, right? So once we pay the capital gains tax, we're looking at $10,500. Once we adjust for inflation, we're looking at just under $1,500. So in 50 years, we've turned $400 into today's value of $1,500. So we've almost quadrupled our money just by putting it in the stock market. Remember, if we put it into a savings account, pretty much break even. If we put it into a mattress, we're losing on inflation every year. So one incredible thing about the stock market also, we talked about that capital gains tax, right? The government wants 15% of the money that you make from your money. So when you put it into a savings account, you're getting that money annually. So you're getting taxed on that money annually. So that money actually can't grow because each year it gets cut down. It tries to grow, it gets cut down by taxes, but it can't. The great thing about the stock market is that you only pay taxes when you pull that money out. So if you let that money grow 10 years, 20 years, you're letting all this tax-free money grow to its full potential, and then at the end, you only have to pay taxes on it once. So that's pretty much most of my very basic, get you in the door investing advice. I think it's important to note that investing is such a valuable tool that it really allows you the comfort during times of transition, when things are going wrong, when you lose your job. You're not having to scramble to find a job that's not right for you. You're able to take your time. You're able to be comfortable in those times of transition that everyone's going to face sooner or later. There's also a time value to money. So if you're investing in your 20s and 30s, you are so much better off than those in their 40s, 50s, and 60s who think that if they start then, they'll be okay. When I was in my 20s, some of the best advice I ever got was live like you're poor until you're 30. And I really took that to heart, and for 10 years of my adult life, I was very frugal, I saved everything I could, and now that I'm in my early 30s, I have some friends who I know make more money than me, but I'm actually financially better off than they are because I have money in the bank that is making more money for me every day. So I hope I've been able to convince you that the stock market is a much wiser investment than a savings account or just holding on to your money forever. As far as next steps go, if you don't have a brokerage, I really think you should open one. Some of the popular ones are Merrill Edge, Ally Invest, TD Ameritrade, E-Trade, and Charles Schwab. Personally, I've been with Charles Schwab pretty much my whole adult life. I really enjoy them. They are one of the ones that announced that they no longer have trading fees, so you can buy and sell for free. Another great thing about them, I'm sure it's the same with the other companies, but I can go in and talk to a financial advisor for free as long as I have an account with them. And those financial advisors, that's what they do for a living. They're very smart, they're very knowledgeable, and they really help you with big purchases like a house, or if you're going to start a family or anything like that, they help you plan for your future. As far as timing goes, when to invest in the stock market is a very important question. There's a term in investing called catch a falling knife. Some people use it positively, some people use it negatively, and they're basically saying that when you invest when the market goes down is actually the best time to do it. The scary thing about the stock market is that basically every emotional impulse you have is exactly opposite of what you want to be doing. So when things are going up, you want to be selling. When things are going down, you want to be buying. So the best way to counteract emotion is to have a game plan and just say, every 2 weeks, I'm going to put X amount into my brokerage, I'm going to invest in the index funds, and I'm not going to think about what the market is doing. Because on a grand scale, the US has been doing incredible for a very, very long time, and in theory, will continue to do so. So people want to know exactly what to invest in. Now, I should say that none of this is any professional advice, and I'm not recommending you go out and buy certain stocks or mutual funds. I just want to have a legal disclaimer of that. That being said, I do like those index funds. We talked about how the index funds have beat the professional hedge fund managers. So I'm going to include a list of just a handful of these. These are just funds to check out to see if they're right for you. They're a good place to start if you know nothing about the stock market. Another good resource is Yahoo Finance. I believe it's finance.yahoo.com. You type in any stock ticker and it'll show you the charts, it'll give you the history, and they also come up with weekly news. So for those starting out, if you do start watching financial news, I want you to know that there are just as many articles that say we have a depression tomorrow versus just as many articles that say the sky's the limit, invest all your money, buy. So that being said, financial news is scary because you don't know what to believe. There's so many people on so many sides that it's really just best to put your money in those index funds and don't think about it for 5 years. Don't think about it for 10 years. Because the more financial news you watch, the more nervous you're going to get, the more emotional you're going to get, and the emotions are not great for investing. So not a ton of nitty-gritty math stuff this week. I did include that one spreadsheet in the description for you to plug in your own numbers, plug in how much you intend to invest, what percentage you think you can get average in the future, and it'll show you just how much in today's value that you'll have in 20, 30, 50 years from now. That's been this episode of Make Money Math Time. I hope you guys liked it. This channel is still very new, so please comment below. Let me know what you like, what you don't like, what you'd like to see in the future. Make sure you subscribe, hit the bell icon for notifications, and tune in every Monday where we do math to make money.